and welcome to another economic and industry update presented by Greenbrier's marketing team. I'm Mallory Moran, and I'm joined by Jay Carter.
Thanks for having me, Mallory.
Let's start with a look into the overall economy. Jay, what are you seeing?
Well, Mallory, if you recall, last quarter, everyone was very excited about the so-called soft landing, right? A soft landing is a situation where there's transition to slow growth that stops short of a true recession. Now, that prediction has been very complicated by the very tight labor market, right? 336,000 net new jobs were created in September. This is double what was expected, and it resulted in an unemployment rate of about 3.8%. This tight labor market increases the chances of longer lasting, higher interest rates, and it's expected to continue into 2024 with an average unemployment rate of about 4.3% expected in 2024. Despite these higher interest rates, the overall economy is showing resilience. Real GDP rose 4.9% in the third quarter of this year, which is more than double the second quarter numbers. Now, the sharp increase came due to contributions from consumer spending, increased inventories, exports, residential investment, and government spending. The GDP forecast has also improved since the last time, with a forecasted growth of around 1% in 2024. The inflation news is promising as well, with headline in September being below 4%, right? Now, this is compared to about an 8% headline inflation number from a year ago. Core PCE, which is the inflation measure used by the Federal Reserve to determine interest rate changes, has also come down since last year at this time. Overall, the data implies that inflation is moving towards the Federal Reserve's target of around 2%, which is a sustainable level. Right now, projections indicate that core PCE is expected to average 2.6% in 2024.
That's all great news, Jay. Let's transition right to the rail industry specifically. Recently, the industry reported third quarter railcar orders, deliveries, and backlog. Now, roughly 9,300 railcars were ordered, down from a very strong second quarter. And then deliveries were slightly down too, with about 10,500 units. And then also the industry backlog, it remains virtually unchanged, right around 59,000 units. While the reported figures are less than what we saw for the fourth quarter last year, these are also strong numbers and in line with what we saw during this year's first quarter. Remember, these figures are very, very cyclical. So Jay, help us put these numbers into context. What are you seeing for railcar loadings?
Again, Mallory, the big story this quarter has been labor, right? The United Auto Workers strike threatened the output of domestic automakers, which often represents a significant portion of traffic. But the good news is that there is now a tentative deal in place with the big three automakers, which should avoid a work stoppage. Auto carloads are up around 13% year to date, and this supports related steel and scrap traffic. There's also encouraging news from the Port of Long Beach, where a ratified labor contract led to its highest container volumes on record in September. However, those are the bright spots in an overall downward trend. A shift in consumer spending from the freight heavy goods to service sector has led to a 4.1% year to date decrease in North American rail volumes. This shipping transition is forecasted to continue through 2024 as those elevated interest rates continue to weigh on demand. Now, on the service front, there have been solid improvements overall this year, right? Year to date velocity through the end of September is up 4.4%, and year to date average terminal dwell for the same time period is down 4% compared to last year. Both key indicators of future railcar demand.
Now, how do these service improvements affect railcars and storage?
As service has improved during a period of depressed traffic, the number of idle units has edged higher. For October, roughly 309,000 rail cars were in storage, and this represents about 19% of the North American fleet. That's a significant increase, but let's keep in mind this is still well below the 7-year average, And it's likely a correction, right, from 2 years of historically low storage levels caused by poor service. Over the past 2 months, there have been about 16,000 grain and fertilizer covered hoppers that have been pulled out of storage as shippers prepare for the harvest. If you recall, last quarter we predicted an increased demand for North American grain due to disruptions in grain production caused by the war in Ukraine, as well as low Mississippi River levels. And that appears to have been accurate.
Any final thoughts, Jay?
So, despite the gloomy news in overall North American loadings, it looks like the downward trend for intermodal has leveled out this current cycle. This is important because, intermodal accounts for about half of total railcar loadings. Now, I expect intermodal has already reached its bottom and volumes should improve steady in 2024, with these improvements being more pronounced towards the latter half of 2024 on better peak season as well as stronger competition to truck.
Thanks, Jay. As we head into 2024, it'll be interesting to see how Greenbrier's strategic plan is affected by these economic trends. As you know, Better Together includes an emphasis on expansion of services and human capital investments, which will be crucial to countering those ongoing challenges that we've been describing. Thank you for joining us. We hope you'll find this video valuable. Be sure to check out next quarter's edition.